Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Redbox's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Redbox is a video rental and streaming service company. It has 38,000 Red kiosks located at convenience stores, fast food restaurants, grocery stores, mass retailers, pharmacies, etc. This month, Chicken Soup for the Soul announced its intention to acquire Redbox for $375 million. Redbox was funded by a SPAC. A special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. This is also known as a reverse merger or reverse takeover. In October 2021, the merger was completed. The SPAC that acquired Redbox was Seaport Global Acquisition Corp. The company is headquartered in Oakbrook Terrace, Illinois, and was founded in 2002. A little fun fact is McDonald's founded this company. The ticker trades on the NASDAQ. Let's get started with the model. This is a micro-cap company, 275 million market cap. They're trading at $6 a share and they have 45 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have positive free cash flow in 19 and 20, but negative in 2021 and the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative each year. Revenue is a sales for the company, and that doesn't look so good. It decreases from 858 million to 275 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that is positive each year, although it's declining a lot. Below that is our operating expenses. Gross profit minus operating expenses gives you your operating income. And that's getting worse each year, negative 162 million in the trailing 12 months. They paid 17 million of interest on their debt. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which is negative every year. This is the company's income statement from the latest 10Q. And this is the first quarter of 2021 versus the first quarter of 2022. Their sales went down from 77 million to 63 million. Sales in their legacy business declined from 68 million to 49 million, but increased in their digital business from 9 million to 14.5 million. You can see in their legacy business, their EBITDA is negative 16 million, but their digital business is positive 2 million. Which makes sense because there's a lot of labor and cost to maintain those kiosks. Where a digital business, it's much more efficient and higher margins. The legacy business consists of the 38,000 self-service kiosks. The legacy business also generates revenue from providing installation and service for other kiosk businesses. The digital business provides streaming services. Most of the money they make on their digital business is from ad revenue. Here's a breakdown of their expenses, $27 million on products. These are the physical DVDs they put into the machines. $30 million on operating costs, $4 million on marketing, $2 million on stock-based compensation, $23 million on G&A, and $25 million in depreciation. So they have an operating loss of $48 million. Last year in the first quarter was an operating loss of $29 million. In the first quarter of 2021, they were not a public company. In the first quarter of this year, they are a public company and their loss per share is 11 cents with 12.7 million shares outstanding. But this number has increased a lot the past few months. They're currently at 45 million shares outstanding. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. Then you have CapEx, investments in property, plant, and equipment. As they focus more on the streaming service and less on the kiosk service, their CapEx should be getting lower. Operating cash flow minus CapEx gives you your free cash flow, and that was positive in 19 and 20, negative in 2021 and the trailing 12 months. It looks like they're doing a good job paying down debt. Each year they pay down more debt than they issue. Let's look at the capital structure. They have negative 31 million of equity, 351 million of debt. So they're 0% equity, 100% debt. And I gave them the lowest whack on Finbox, 13%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 792 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $560 million. We divide that by 45 million shares. And we get a calculated stock price of $12. They're trading at $6, so they're trading at a 51% discount. It's a buy according to the model. Their revenue forecast for 2023 is 671 million. And then their revenue forecast for 2022 is 409 million. I grew the number 10% into 2024 and 2025. That's how I got their future revenue estimates. The average company in the market converts 10% of their revenue into free cash flow, so I multiplied their revenue by 10%. That's how I got their future free cash flows. And I assumed they would have negative free cash flow in 22 and 23. The website Simply Wall Street is on another planet. Their valuation is $62. They're saying it's 92% undervalued. 4 analysts priced this stock and the average price target is $2.22, the lowest 65 cents, the highest $3. This chart shows the company's stock price historically, and all SPACs started at $10. And once a SPAC announces an acquisition target, the stock price goes up pretty quickly. And this got over $15. Then it came crashing down real fast. It looks like it bottomed out at about $1.50. But the reason the stock price has come up is because they are an acquisition target. The company Chicken Soup for the Soul said they plan to acquire this company. If the acquisition does not go through, the stock price still can go up. So if you were able to see into the future, you could have got a great deal down here. But it'd be hard to predict this company would be an acquisition target just a few months after it got acquired by the SPAC. The stock is down 46% in the past 52 weeks, while the S&P is down 7%. The 52-week low is $1.61, the high is 27. And the stock is trading between its 50-day and 200-day moving average. This is a really popular stock. Almost 19 million shares are traded each day. 86% of the shares are held by institutions, and it has a really high short percentage. Over 23% of the shares are shorted. If you put $10,000 into this company when it started trading as a SPAC, you'd be at $5,300 today. That's a 47% loss. The CEO's annual salary is $720,000, and their total compensation package is over $10 million. Half the company is owned by hedge funds, 16% by individual insiders, 14% by venture capital and private equity firms, 8.5% by institutions, 7% by the general public, and 6.5% by private companies. The biggest shareholder is a SPAC that acquired this company. They own 35% of the stock, then Apollo, Standard General, then another company that owns 6.5%, and another one that owns 6%. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have a good price to sales of 1.0, that's stock price over sales per share. This means their revenue equals their market cap. We can't look at the price to book since they have negative equity, and we cannot look at the price to free cash flow since they have negative free cash flow. Let's look at their non-current assets. 37 million of property and equipment, 148 million of goodwill. Goodwill is the premium you pay when you acquire another company. 106 million of other intangibles. The value of the assets they lease is 8.3 million and 600,000 of other. Let's look at their non-current liabilities. 300 million of long-term debt, 4 million of warrant liabilities. Warrants are long-dated options. 6 million of operating leases and 11 million of other. Their current ratio is 0.4, so they can only cover 40% of their current liabilities with their current assets. Let's look at their current assets. 14 million of cash, 14 million of accounts receivables. This is how much money their customers owe them. 4.4 million due from related parties. They do acquire lots of content for their streaming service. The value of that content is $23 million. and $7 million of prepaid expenses. A prepaid expense is when a company makes an advance payment for a product or service they're going to receive in the future. Let's look at their current liabilities. $39 million of trade payable. This is how much money they owe their vendors. $3 million of operating leases that are due within the next 12 months. $59 million of accrued and other current liabilities. An accrued liability occurs when a company has incurred an expense they're going to pay in the future. They owe $42 million of their long-term debt within the next 12 months. They lost $42 million of free cash flow in the trailing 12 months, and they have negative $80 million of working capital. So they're definitely going to need funding to get through the next 12 months, unless they get acquired, of course. To summarize, I have them trading at a 51% discount, but this is a moot point if they get acquired. But if they don't get acquired and you buy the stock, there is still some upside, especially if the company can grow their streaming service. Because I don't think the kiosks is a good long-term plan. I rank their free cash flow as 1 out of 10, their revenue 1 out of 10, and the ratio is 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.